Welcome back to our channel. Are you ready to discover the best way to generate passive income and build a profitable portfolio? In this video, I'm going to share with you my top tips for choosing dividend stocks that will pay off big time. Whether you're a seasoned investor or just starting out, you won't want to miss this. So, let's dive in and find out how you can start earning more with dividend stocks. Before we get started, let's take a moment to understand what dividend stocks are and why they matter. Essentially, dividend stocks are shares of companies that pay out a portion of their profits to their shareholders in the form of regular dividends. These dividends can provide a steady stream of income and can be an attractive option for investors who are looking for a reliable source of passive income. In fact, many successful investors have built their fortunes on dividend stocks. So, if you're interested in building a profitable portfolio, dividend stocks could be a great place to start. Let's take a closer look at the key features to consider when choosing dividend stocks. First, you'll want to look at the dividend yield, which is the amount of money paid out in dividends each year relative to the stock price. A higher dividend yield can mean more income, but it's important to also consider the company's ability to sustain those payouts over time. A higher dividend yield can be an attractive feature for investors as it indicates a higher payout relative to the stock price. However, it's important to be cautious when evaluating companies with high dividend yields, as this can sometimes be a red flag. One reason for a high dividend yield could be that the stock price has fallen significantly, which may be an indication of financial troubles or other underlying issues. Additionally, a company may be sacrificing future growth opportunities in order to maintain high dividend payouts, which could be a concern for long-term investors. That being said, a higher dividend yield can still be a valuable feature if it's supported by strong financial fundamentals and a commitment to sustainable dividend payouts. When evaluating dividend stocks, it's important to consider a variety of factors beyond just the dividend yield, such as the company's payout ratio, dividend growth rate, and overall financial health. Next, you'll want to look at the payout ratio, which is the percentage of earnings paid out as dividends. A high payout ratio can indicate that a company is paying out more than it can afford, which could be a red flag. The payout ratio is an important metric to consider when evaluating dividend stocks. It measures the percentage of a company's earnings that are paid out as dividends to shareholders. A high payout ratio could indicate that the company is prioritizing dividend payouts over other uses of cash, such as reinvesting in the business or paying down debt. This could be a concern if the company is not generating enough earnings to support sustainable dividend payments. On the other hand, a low payout ratio could indicate that the company has room to increase its dividend payouts in the future, or that it's retaining earnings to fund growth opportunities. However, a very low payout ratio could also indicate that the company is not committed to paying dividends or does not have a sustainable business model. When evaluating payout ratios, it's important to look at trends over time and compare them to industry benchmarks. A company with a consistent track record of sustainable dividend payouts and a reasonable payout ratio can be an attractive investment opportunity for income-seeking investors. Finally, you'll want to consider the dividend growth rate, which is the rate at which a company's dividend payments are increasing over time. A consistently growing dividend can be a good sign that a company is financially healthy and committed to rewarding its shareholders. The dividend growth rate is an important factor to consider when choosing dividend stocks. It measures the rate at which a company's dividend payments are increasing over time. A consistently growing dividend can be a good sign that a company is financially healthy and committed to rewarding its shareholders. For example, let's say company A has been paying a dividend of 1 peso per share for the past 5 years, while company B has been paying a dividend of 0.50 peso per share for the same period. However, over the past 5 years, Company A has increased its dividend payout by an average of 5% per year, while Company B has only increased its dividend payout by an average of 2% per year. In this case, Company A may be a better investment option because it has a higher dividend growth rate. Keep in mind that a high dividend growth rate doesn't necessarily guarantee that a company will continue to increase its dividends in the future. It's important to also consider the company's financial stability and its ability to sustain those payouts over time. By keeping these factors in mind, you'll be able to evaluate dividend stocks and find the ones that are best suited for your investment goals. Now, let's compare two popular dividend stocks, LTG and DMC. LTG has a dividend yield of 8.74%, a payout ratio of 5%, and a dividend growth rate of 35%, DMC has a dividend yield of 8.7%, a payout ratio of 14%, and a dividend growth rate of 10.75%. At first glance, LTG may seem like the better option because it has a higher dividend yield and a lower payout ratio, which means it's paying out a smaller percentage of its earnings as dividends. However, when we look at the dividend growth rate, we see that LTG has been increasing its dividend payments at a faster rate than DMC. Ultimately, the best choice depends on your investment goals and risk tolerance. If you're looking for a higher income stream, LTG may be the better choice. But if you're willing to take on a bit more risk for the potential for higher returns, DMC may be worth considering. Remember, it's important to do your own research and carefully evaluate each stock before making any investment decisions. Choosing dividend stocks can be a challenge, even for experienced investors. One of the biggest challenges is balancing the desire for high dividends with the need for a stable and financially healthy company. It's important to remember that a high dividend yield may be tempting, but it can also be a red flag if the company is not able to sustain those payouts over time. Another challenge is navigating the complexities of the stock market and analyzing financial data. It can be overwhelming to try to understand all of the different metrics and ratios used to evaluate stocks. That's why it's important to do your own research if you're unsure about anything. Finally, it's important to be patient and take a long-term perspective when investing in dividend stocks. While the income stream from dividends can be a valuable source of passive income, it's important to remember that stock prices can be volatile in the short term. By focusing on companies with strong fundamentals and a commitment to dividend payouts, you'll be better positioned to achieve your investment goals over the long term. In conclusion, choosing dividend stocks can be a lucrative investment strategy for those looking to earn a steady income stream. When evaluating dividend stocks, it's important to consider factors such as the dividend yield, payout ratio, and dividend growth rate, as well as the overall financial health and stability of the company. Remember, investing in the stock market comes with risks, and it's important to do your own research before making any investment decisions. By taking a long-term perspective and focusing on companies with strong fundamentals and a commitment to dividend payouts, you can build a diversified portfolio of dividend stocks that can help you achieve your financial goals. I hope you found this video helpful in understanding how to choose dividend stocks. Remember, investing in the stock market can be a powerful tool for building wealth, but it's important to do your own research and carefully evaluate each investment opportunity. If you have any questions or comments about this video, feel free to leave them in the comments section below. And if you found this video helpful, please give it a like and consider subscribing to my channel for more investing tips and insights. Thanks for watching and happy investing!